Welcome to Deloitte's Debrief Tax Webcast series in Asia Pacific. Our webcast today is from our corporate income tax series entitled Structuring for Special Purpose Acquisition Company, Listing, Tax Consequences, and Other Key Aspects. My name is Himal Mehta, and I am a tax partner based out of Deloitte India Mumbai office. I have the pleasure of hosting today's webcast. I have two speakers with me today, Jack Tay and Hong Ye. Jack is an audit partner based in Deloitte Singapore office, and Hong is also a tax partner based in Deloitte China. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I did like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We will do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile devices users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. With this home rules, I would like to hand over the presentation to Jack, who is my colleague, to start the discussion on the agenda and the basics of SPAC. Jack, over to you.
Sure. Thank you, Hima. Hello, everyone. My name is Jack. I'm a partner based out of Singapore. Very happy today to talk about this new term that until most recently has been quite foreign to, I guess, most of us, SPAC, or Special Purpose Acquisition Company. So today we'll be covering a few items, overview of the SPAC, talk a bit in terms of the tax regulatory requirement for China and India, and last but not least, to just cover a bit of the service offering that we have. So on the next page, let's cover a bit on what is a SPAC. Next page, please. And why is it so attractive and getting so much attention over the last few months? So a SPAC is not new. This concept has been around for the last few, I would say last decades already, but it gets a lot of attention over the last few months. And essentially, it is a shell company or a blank check company set up by the management team that often with a track record of M&A transactions. Through an IPO, investor put their money into a trust account within the SPAC with the hope that the management team could source for a good M&A target. And once a deal is identified, the so-called de-SPAC process begins. It's not much different from a regular M&A to a large extent where you have due diligence process, you negotiate between the two parties, you SPA that needs to be signed off. And once the deal is closed, i.e. the merger of the blank check company and the target operating company, you have then a successful public listed operating company. Next, a quick overview of the SPAC itself. The SPAC's governing documents would normally set a time period in which the SPAC have to complete a transaction, usually between 18 to 24 months. If the SPAC is not able to complete within the time frame, then the money that has been put into the trust account would then need to be returned the investor. Or if it's able to extend it further to about 36 months, the SPAC can be listed on NASDAQ or New York Stock Exchange. And it's worth noting that about 81% of them are currently listed on NASDAQ. Usually you have IPO units at $10 per unit and will contain the common and warrant to purchase common stock. And on the M&A transaction itself, fair market value of the initial transaction must be at least 80% of the asset held by the trust. In reality, you often see that acquisition to be typically 2 to 4 times of the SPAC size. So essentially, if you are looking at a SPAC with $200 to $300 million in its war chest, then potentially you could the transaction close to $1 billion. Next, from a timeline perspective. So from a timeline perspective, you would often see the SPAC take the following 5 stages: formation, IPO, target search, stockholder vote, and then ultimately the acquisition close. So when the SPAC is launched, the sponsor, or often its management team, pay a nominal amount for the equity stake in the SPAC, which we call the founder stock or the promo. The founder stocks that the initial investor receives generally is about % of the stock in the SPAC, so it's IPO. And the founder stock is really intended to compensate this initial investor for the work they are doing, identifying the target, closing the transaction. And usually during this stage, you also have the sponsor being the one that lends the SPAC the money to fund the ongoing expenses. And during this process, the SPAC will select the counsel and underwriter to establish its governing document. Then after it's being formed, the SPAC the public offering. At this point, the SPAC file its IPO document, go through the normal SEC processes, raise its capital by issuing the units if the IPO is successful. And actually, that's where the real work begins, right? They start the target search, look for a good target to close the transaction. We call this a target search process, as much as it's also actually the same phase for the operating company to searching for a suitable SPAC. So from a timing perspective, from the operating target side of the things, other than talking about LI, term sheets, the important work stream will also be gearing up itself to prepare for the SEC filing, to prepare for all the financial statement reporting requirements. And if your company is at this stage now, I would say it's important to also engage with your auditors and advisor to really understand the audit requirement under PCAOB standards. And sometimes it's not just about audit, and also the auditor independence as well, because your auditors previously may not have to subject themselves to SEC independence rules. And last but not least, key aspect also include the tax structuring. So depending on the jurisdiction that you are in, there could be certain rules or indirect tax transfer, which Pema and Yehong will be covering later on, because essentially this SPAC is M&A transactions. So once the audit is completed and the M&A due diligence process completed together with the other tax structuring process, you file a definitive agreement, or you sign a definitive agreement and do a filing with the SEC. And again, another 2 to 4 months time of review process by SEC would happen. And once SEC okay the proxy, it will be mailed to the shareholder for approval and the transaction close. One thing to note is that subsequent to the transaction being closed, a Super 8K has to be filed. And what this Super 8K means is that the company needs to start thinking about the other financial information that we require for the public company going forward. So now let me turn over to Hima to talk a bit about why is SPAC so popular.
Thank you, Jack. So as Jack rightly said, SPAC is probably nothing new. It is an old wine in new bottle. Comes up every 7-8 years. So if you see the total capital which is raised till now, it was about $83 billion up to 2020. And as we talk today, up to 2021, at current period, the number which I get is about $103.6 billion. Massive amount. The largest SPAC which we have seen happening today in the market was Pershing Square Tontine, and it's just $4 billion raised. And there was some large de-SPACing which are announced. Some of the large ones which I am aware of is Oars Holding 4, which was merged with UWM Holdings Corporation, which was about $16 billion deal. The other one was Churchill Capital 3, which got merged with Multiplan, which was about $11 billion deal. So these are real large transactions. From the overall perspective we have seen, and let me just give you a perspective from India and China. China certainly leads the Asia Pacific bandwagon on SPAC listing, but India also had a very successful listing currently, which was Renew Power, which is probably the talk of the town in India. Everybody talks about renewable power today. There are one or two which are under process. But if you go back to history, we have seen that there were two SPAC listings which were done from India. One was Videocon D2H, and other was Yatra Online, which is online portal. Having said this, just giving a perspective, if you see the sectors which probably has attracted most money or the most investment from SPAC, certainly is led by technology, financial services, healthcare. A small contribution has been given by automotive. Consumer also has got a sizable share. Energy has got a sizable share. Real estate also has got a share. It means that it is basically done for almost all sectors. But certainly the lead is always telecom, technology, and financial services, mainly fintech. So this is just an overview of how the SPAC has probably been performing in the last couple of years. Moving to the next slide. What is the difference? What is so special about SPAC as compared to traditional IPO? And this question actually comes up all the time. One point bullet answer is that in SPAC, the company can see the money upfront sitting in an escrow account, which is under a trust. In traditional IPO, all the work is done beforehand, and then an IPO is been launched in the market. So in SPAC, only the hard work is done to raise the money. After that, they find out who are the targets and where they can invest. While in traditional IPO, the target does all the hard work beforehand, and then they go and raise the money. But if you see some of the common characteristics, the point which we are driving is that SPAC is not easy as compared to traditional IPO. There are no shortcut to SPAC. The only difference is what is the stream of work, what is the implementation plan. It may be different for SPAC as compared to traditional IPO. So access to additional capital, public currency for M&A transaction, public currency for management, employee compensation remains same between SPAC and traditional IPO. What changes is the use of projection and marketing material, where it is important for SPAC, not so much important for IPO. IPO, of course, looks at the past performance. IPO process requirements include delivery of audit and SEC review process. It is standard for both. So if any client or anybody thinks that SPAC is a shortcut, the answer is no. It's just that the process probably is done in two different stages. Transparent price, discovery mechanism, additional cost in form of sponsor promote, flexibility in structuring economics, closing risk due to shareholding, voting and redemption rights, and speed to execution are all present in SPAC, which is not required to do in IPO. And last is post-closing compliance with public company requirements, similar for SPAC and traditional IPO. So the point which I'm harping on again is that this is not a shortcut. It's just that the process has been divided into two different phases. Jack, over to you.
Sure. So as mentioned, I mean, it is not exactly a shortcut. There is quite a fair bit of information that needs to go into the SEC filing. So here we put down the key information of the target that needs to be included. So this is the information that you expect that needs to go into the proxy form to be filed with SEC and subsequently to be approved by the shareholder. So you will be required to put in the target financial statements, as well as any significant business acquisition done by the target or any significant equity method investee of the target. So essentially, all the information about the target needs to go into the SEC filing. And in terms of the number of historical period that needs to go in there, it really depends on whether the target will qualify as what we call a emerging growth company, and depending on whether the SPAC that the target is merging with has filed an annual report already or not. So a lot of this needs to be thought through to make sure that you file the right financial statement in the SEC, and obviously the amount of what they will come along with it. Other information also include the pro forma financial information for the proposed acquisition, MD&A, which is typical than what you see in a SEC F1 filing or IPO document, selected historical financial data, and included that the target known financial information such as the risk factors, the disclosure around market risk, business section, and other stuff. So it's quite a lot of things that actually have to go in there, and hence, as much as it is a faster process, there is a lot of groundwork that companies should be thinking about or starting to work on if this is the route that they choose to go. Next, as you could tell, there are quite a lot of work. So in terms of the common challenges that we see, no surprises, we often see a strain on the people. All of us have a day job in the finance operation, and more often than not will not be familiar with the US listing requirement or SEC rules. Hence, it's always important that appropriate internal resources are being put in place with good understanding of regulations, also auditing standards. And I would say it's also important to engage the advisor at the onset, make sure that you have the right people to help you through the process. The right understanding of the requirement, a proper process will definitely need to be put in place to start managing different work streams, which includes your due diligence process, your tax structuring process, and more often than not, the more serious one from a finance perspective will be also the whole PCOB audit process. Hence, you got to start organizing yourself, understanding the requirement, have the right people, right process put in place. And last but not least, at this age, technology will often be a key success factors. One of the work stream that needs to be thought about definitely include upgrading the accounting system, support the company going forward as a public company, and also from an internal control and forecasting perspective. As mentioned, tax is an important factor that will need to be considered. Now we have Ye Hong, our tax partner from China, who will talk us through some of the tax issues that you typically see in China context.
Thanks, Jack. Next slide, please. Before I dive into the China tax considerations of the de-SPAC transaction, let me say a few words about some general tax considerations for Asia Pacific business on de-SPAC transactions. So de-SPAC, as you can see from this circle, is the last stage of SPAC lifespan. So typically, SPAC will look for a target, or sometimes actually target look for a SPAC. And when they meet, they negotiate a deal, and then they will try to complete what we call a de-SPAC transaction. That's where the target and the SPAC will combine, and then the target will be listed through the SPAC. So this process or transaction is typically referred to as de-SPAC. Structuring the combination of a SPAC with an Asian business could be quite complex and very, very transaction specific. So it typically involves decisions such as optimal tax structure for both entities and their stakeholders or shareholders during this business combination. Also decisions like where it should be the desired jurisdiction of incorporation and the headquarters of the combined business all need to be considered. Also, the desired profile of the combined company as a U.S. public company all need to be thought through. Also, because in Asia, each Asian jurisdiction has its own rule and business combination and all its own tax regime. So the structure need to be analyzed for each proposed de-SPAC transaction, and each transaction probably has to accommodate specific situation. So from a China perspective, if the target has one or more Chinese subsidiaries, the most relevant tax issue actually would be the indirect share transfer implication. And if the target has Chinese shareholders, then the most relevant issue will be a direct share transfer. Next slide, please. So let me start with explaining what this indirect share transfer rules is. It's often also referred to as Bulletin 7. Some of you may have already quite familiar with this rule. Under this rule, a seller or a transferor which transfer the shares in a non-resident company directly or indirectly owning shares in a Chinese company could be subject to tax in China on the gain attributable to the shares in the Chinese company. So depending on the profile of the seller and the transaction, the rule actually provides for a few specific exceptions. One exception is the tax-free exemption. This is probably most relevant exception to a de-SPAC transaction, and I will explain later in an example. Other exceptions, such as listed stock or listed equity exemption, internal reorganization, safe harbor, would typically not applicable to a de-SPAC transaction. If the target is a China-based offshore entity, we have quite a few actually China-based entity went public through a de-SPAC process. One actually need to watch out for what we call blacklist transaction provisions in Bulletin 7. For many targets that are owning Chinese subsidiaries, a general factor test would need to be analyzed, performed to determine whether the transaction would be taxable. The general factor has to look at 7 specific factors, such as how big is the value in China versus value of the entire group, how much income from China versus income of the entire group, what's the risk and the functions outside of China in the holding, in the intermediate holding company, whether any foreign tax is paid by the transferor or seller, whether there is a genuine commercial purpose, when this holding structure is put together, was that put together to avoid China tax, et cetera, et cetera. So I have a few examples. So let's move on to some examples to see how Bulletin 7 would apply. Next slide. Yeah, here we have on the left side a SPAC. Maybe let me say also a few words about SPAC, the tax considerations. A significant proportion of SPAC targeting non-U.S. incorporated targets actually incorporate in Cayman Islands and other jurisdictions, not in U.S., because you don't want to subject the de-SPAC company to U.S. tax. So there often involves reincorporation of SPAC, or what we call migration of SPAC from U.S. to another jurisdiction. And also from a China perspective, SPAC investors typically would not be onshore Chinese investors because the onshore Chinese investors are subject to Chinese regulatory rules on outbound direct investment. And then also there are SEC restrictions on listing a China company in the U.S. So the Chinese investors would not be able to invest in SPAC unless it has already an investment vehicle outside China. So that's where they could invest in a SPAC. So for the illustration purpose here, I just assumed that SPAC would not have Chinese investors or Chinese sponsors. So on the right side, that we have a target, an offshore target with a variety of shareholders, and we have corporations, we have partnerships, we have individuals. Here, I assume all the investors or shareholders are non-Chinese tax resident. Next slide, please. So here, we on the next slide, we have a merged. Sorry, my slides are not moving. We have a typical SPAC. Can you see the slides? My slides are not moving. But anyway, so there is a typical combined structure where SPAC is on the top. So this is a typical de-SPAC transaction, and typically this is done by SPAC form merged sub, and the merged sub merge into a target with target surviving. So this is the typically what we call reverse triangular merger. Here, the SPAC would actually acquire the target by issuing shares to target shareholder, and in exchange for target shareholders' shares in the target. So what you can see here is that the target shareholders actually transfer their shares in target to the SPAC. So there is what we call Bulletin 7 transfer. So, so let's look at the corporate and the partnership shareholders. Typically, a corporate shareholder, if owns less than 25% in the Chinese company indirectly, then it may be able to claim 3D exemption if it is located in a 3D country, and its ownership is less than 25%, as I said. However, if the investor is a partnership, then most likely it's out of luck to claim the 3D benefit. China generally don't respect a partnership, which is a transparent entity, as a resident to be able to enjoy any benefit. Okay, and the individuals, that's actually very interesting. The foreign individuals are not subject to Bulletin 7. However, we do have individual income tax law, which have a principle that's very similar to the principle that found Bulletin 7, which is anti-avoidance rule. So the question is whether the foreign investors could be caught under the general anti-avoidance rule. And so far, we have not seen this happening in China. So the authorities are not challenging the individuals' indirect transfer in China. Sorry, my screen is not moving, so I'm reading my. I have to go through my my paper deck.
No, so Hong, sorry, I'm interrupting you, but the slides are moving for us. So currently we are on case study 1, application Bulletin 7. We are moving to the next slide now.
Yeah, okay, good. Is there a way for me to refresh my, okay, now it's moving. Okay, thanks. So sorry, I should go back to a few more points. For the corporate and the partner shareholders, if they are not able to enjoy the treaty exemption, then typically they will have to go through what we call general factors test to see whether they would be subject to tax in China. But as I said, that typically we look at the target's assets, value, and income from China versus from outside of China, and whether there's any substance outside of China. So typically, if target itself is not a China-based entity, let's say it's a genuine U.S. entity or Singapore entity, etc., you may be able to pass this general factor test and not to be taxed under Bulletin 7. But that analysis needs to be done. If the target actually is a China-based company with an offshore holding structure, then we have to be careful with the blacklist rules. The blacklist transaction rules basically will subject a transaction to Bulletin 7 if most assets and the value of the group resides in China and no function, no risk outside of China. So this is typically a risk for Chinese company. So let's move on to the next slide. On the next slide, yes, this is a different structure where you can see actually target is on the top. Okay, so this is another variation of the de-SPAC transactions. There could be other variations of de-SPAC transactions. I think Timo is going to show at least one more. So here, actually, it is again a reverse triangular merger. However, it's the SPAC investors actually would exchange their shares in SPAC with the shares of Target. In other words, Target will issue shares to SPAC investors. So the question is here whether the investors or the shareholders of Target will still be subject to China's Bulletin 7 rules. Okay, so the threshold question is for the shareholders of the Target, is there a share transfer? Here what we see is that the shareholders of the Target ownership percentage will decrease due to the dilution, right, of their ownership because the SPAC investors coming to the picture. However, their economic ownership or the value of their ownership should not reduce theoretically if this is arm's length transaction. And from a legal perspective, there is no share transfer by the shareholders. So in this case, I think one need to consider whether there is argument you can make in relation to Bulletin 7. The argument is there a transfer or there is no transfer by the shareholder of the Target? Therefore, Bulletin 7 should not apply. So I showed this structure just to illustrate when you structure a de-SPAC transaction, there could be different valuations, and that would result in different tax considerations for different stakeholders. And you have to choose the one that probably works best for all of the stakeholders. Okay. So move to next slide, please. So the next slide is this illustration of some tax implications for the Chinese shareholders in a Target. For Chinese shareholders, if we go with the most common structure where SPAC is on the top, then there will be a direct share transfer for Chinese shareholders. And we do have to, they will be subject to tax in China. If a corporation, then the corporation will be subject to tax in China. If it's partnership, then the partner will be subject to tax in China. Partnership is transparent. And if the individual, they will be subject to tax in China. However, if this individual is like employee stock option, and I think one need to consider whether there's some arguments can be made here. A rollover arguments, meaning that the stock option or the incentive plan just simply roll over from one entity to another without any realization or vesting, etc. So that be exempt from tax. So these are all the considerations when Chinese shareholders are involved. And last, is there a stamp duty in China paid? Again, it's something to be analyzed. So I think this is all I have for my slide. Timo, I think I can pass the slides back to you.
Sure. Thank you, Hong. So I think the tax regulatory issue which Hong mentioned about China are not vastly different from what we have in India. But I think one additional point which we require to consider from India is actually the regulatory consideration. Most of you who must be dealing with India is aware that India has got a provision called Foreign Exchange Management Act, and it has got some guidelines laid down for how an Indian investor will hold shares outside of India. And on the other hand, when an Indian investor holds any shares outside of India of a listed company, say a SPAC, which is listed on NASDAQ by any listed company, and that company in turn holds any shareholding in India directly or indirectly, it may tantamount to round tripping And in that situation, a regulatory approval is necessary. So when we look at structuring a SPAC transaction from India perspective, the four contours are that when we talk about the sale consideration, we want to make sure that under the FEMA regulation, whether the considerations of any transfer or any exit is as per the FEMA regulations or not, and whether the consideration is in kind or is in cash. The second point comes up is on the withholding tax. When any transfer happens during de-SPACing, and if any investor gets an exit, then of course there is an issue of withholding tax in India on direct or indirect sale. India also has now a very detailed guidelines on indirect transfer, similar to China, what Hong did mention about the Bulletin 7. And I have covered in greater detail in the next slide, but let me finish this one. The third point, which is very important, is timing of offshoring. What is the timing of offshoring of an Indian company before a SPAC listing happens or a de-SPACing happens? Whether there is enough gap of timelines or which we can explain to the regulators, or we think that the offshoring has happened at the same time when a de-SPACing has happened. And if so, what are the implications on the same from tax as well as from the regulatory perspective? And the last one is basically nothing else, but it is basically talking that if an Indian promoter, an Indian resident is holding directly, indirectly, say a sponsor shareholding in SPAC, or they may be holding, say, board position, or they may have an influence in the board of a listed entity to invest in India, then we also require to see the control issues, whether it creates some kind of an effective management in India or not. And if yes, what are the tax implications? Moving to the next slide. The next slide actually focuses more on the indirect transfer. And it is no different than what China has. Maybe some of the regulatory regulations, some of the compliances may be different. And I'm sure most Asian countries will have these regulations, which we have to adhere to. What is the trigger point of indirect transfer? And what is the exemptions which we have? What are the safe harbor rules we have? And what are the key considerations? In short, as Hong rightly mentioned, that every de-SPACing or every transaction on SPAC probably requires to be, whether it's a separate transaction, we cannot probably have a same brush painting both the transactions. It is a tailor-made transaction. And when we are doing any discussions or any review or any structuring work for such transaction, we keep in mind whether we have any trigger points of indirect transfer tax in India or outside of India, especially in China. If the de-SPACing actually looks at us holding or investments coming into India as well as in China, or maybe other Asia Pacific countries. There are certain threshold limits which are mentioned for triggering issue, but there are certain exemptions as well, which we are talking about. The exemption mainly comes from tax treaty benefit. Again, not tested completely, but today we have some precedents to say that there are treaty benefits available. If a holding structure before coming to India is in the overseas jurisdiction. And if we go back to structures, maybe 5, 10, 15 years back, we always used to talk about double layer holding structure outside of India, maybe in Singapore, maybe in Mauritius, to get some indirect transfer benefit. And today those structures are standing the test of the law. On the safe harbor, of course, depending on what is the percentage holding of each shareholder, that depends on how the safe harbor laws will be applicable. There is a dispute, or there probably is not enough clarity that when an Indian shareholder holds shares of a listed company, which is a SPAC entity listed on NASDAQ, say for example, and that entity in turn actually holds shares in India, right? Whether a round tripping will really be considered. I touched upon that probably from regulatory perspective. But when that said Indian shareholder transfers those shares in the listed shareholding, listed entity, whether it will trigger an indirect transfer tax. No clear answers. It is a question of debate, and it depends whether we are still get covered the safe harbor rules, or if not, what is the view we should take, and what are the key considerations, which is beneficial ownership, business rationale, control management, fund flow, etc., etc. So these are the 4 different aspects of indirect transfer tax we would like to examine from India perspective. What similarly Hong mentioned about China. Moving to the next slide. We have just given two simple examples. The examples which Hong mentioned are no different as compared to the Indian examples. But I still say that from the Indian perspective, just to discuss the point of regulatory slightly in greater detail, we said let us take up two examples. This is a simple one. I've got an Indian company which is held by Indian promoter. There's a SPAC, which is a listed entity sitting with money. And if you see the third on the right-hand side structure, the ultimate structure is that SPAC is actually investing in India under FDI, and the Indian promoter holds shares in India. The challenge comes when the Indian promoters are also holding shares, maybe as a sponsor or maybe as an investor in a SPAC entity, which is a listed entity. So if you see that arrow is going to create all the challenges in India from the regulatory perspective. Whether we require to seek RBI approval. RBI is our central, Reserve Bank of India is our central bank in India, which manages the overseas direct approvals. So whether we require to take an approval of RBI, if yes, whether RBI is going to give approval or what is the time frame, and can we do it post the transaction or pre the transaction? These are some of the critical issues which keeps coming up on the discussion table all the time. On the taxability in this structure, it's a simple investment from SPAC into an Indian operating company. It will be considered a foreign direct investment. And in this situation, the Indian operating company and the SPAC entity, the investing company, both will require to make sure that they comply with the regulatory regulations for investments in India. Moving to the next slide. This case study is slightly ticklish, and these are the case studies which keeps coming on our table on a regular basis. Here, if you see on the left-hand side, the structure is that I've got a client, and I've got a client which is a foreign company, which actually holds 80% shares in India company, and 20% are held by the Indian promoter. The company in turn has got a 100% subsidiary, a 60% subsidiary company in the US, and balance 40% is held by the foreign company. So essentially, it's a 100% company, subsidiary company of foreign company. Now, when we are looking at SPAC, there are two structures we are talking about. One is the Delaware 2 company in the slide as it looks like, which is a SPAC entity which is listed on NASDAQ, which has got a sponsor shares holding, which has got a public shareholding, and the money what they have raised, say $100 million, for example, is sitting in an escrow account, which we call as sitting in a trust account. Now, before we go for SPAC, the structure which we thought was that we probably created a Delaware 1 entity where step one, we suggested to merge the foreign company into Delaware 1 entity. By doing that merger, if you see the orange mark which says 1, first step was to merge foreign company into Delaware company. By doing this, 80% shareholding in India company moved to Delaware company, and 40% which foreign company used to hold in US company also moved to Delaware 1. Effectively, Delaware 1 became the new holding company. After this stage, the 20% shareholding of promoter was acquired by Delaware 1, say in this case, or if it doesn't acquire, if they continue as an Indian shareholder. There is no problem. Once this was done, the next step is to merge the US company into Delaware 1. And this is only because we wanted to make sure that Delaware 1 becomes an operating company. So when Delaware 1 gets reverse merged into Delaware 2, which is a SPAC entity, which is a listed entity, the operations which is sitting in Delaware 1 moves to Delaware 2, and Delaware 2, the listed company, will be operating company as far as the US business is concerned, and will be holding 80% shares in the Indian company. So the Delaware 2, which is a SPAC entity, listed entity, will be considered as an operating holding company. And that's how the entire structure works out. Now, on this slide, it is only 3 steps we are talking about. But when we are working on this transaction, and we are currently actually working on this transaction, we are in advanced stage of closing. There are total 10 steps which we have taken to move to the ultimate structure. There are 10 steps we have structured, because we wanted to make sure that every step we are very careful about the Indian regulatory and Indian tax implications. So how effectively we can do it from both the perspective was the key consideration on structuring when we were working on this particular structure. This is only to just give an idea to the audience, but it's the actual structure was slightly more complex. So these are 2 or 3 points which I want to discuss from India perspective. Hong, of course, mentioned about China perspective. I would like to give it back to Jack Jack, why don't you share some of the issues which you see from the audit perspective, accounting perspective, and some of the common issues which we address, and what are the service offerings? Jack, over to you.
Sure, Hima. So I think often tax will drive a lot of the structuring in a M&A transaction, and in this case, because I was mentioning, this SPAC essentially is an M&A transaction in its own way. So those structuring issues definitely need to be ironed out prior to the signing of the definitive agreement between the SPAC and the operating target. Hence, it's important that you engage with your tax advisor as early as possible and don't wait to the later part of the process to look into that. Here we put down the type of service that we could provide from a tax perspective. And I guess aside from tax, you're given the huge amount of workload that require for the de-SPAC process, we often will also be helping our client to assist them in areas such as preparation of the financial statements under the respective gap. I think in dealing with any technical issue that could come up during the process, be it through the SEC review process or even before submitting the document to SEC, we do want to make sure that all the technical issues are ironed out. The 2 to 4 months SEC review period could be shortened only if the document that is being submitted to SEC, and hence a lot of groundwork, prep work should be done to make sure that the process is as smooth as possible. Other areas would help MD&A, market risk disclosure items, and all the technical areas as well. And often, I guess the constraint phase of our client is usually hence it's also quite common for us to get into the closing process to help speed up the financial closing using the analytic technology to try to close the book faster in order to meet the required timeline as the company become a public company going forward. I think we realized that at the onset, a quick IPO readiness diagnostic usually could help to align expectation between the different stakeholders, be it the founder, the finance team, the banks, or the promoter, the sponsor itself. So knowing where are the reporting gaps from a finance perspective, knowing where are the key work streams that need to run and how long they will take, where are all the internal control issues that could pop up and need to be remediated. At the onset, I think will really help to ensure a successful de-SPAC process. That's all we have for the service offering. Passing back to you, Hima, on any question and answer.
Thank you. Thanks, Jack. Thanks, Paul. So, audience, thank you so much for patient listening or hearing. May I request you to post any questions if you have, any clarification you seek on the console on your right-hand side, and we would be happy to take a few questions. In the meantime, audience, when you put a question, I have a very basic question for Hong. At Hong, that in China, let's presume that any company or any investor is looking at investing in China by de-SPACing. How much time you think it takes before a structuring exercise can be closed? And the other point is that what is your experience about the tax efficiency of that de-SPACing? You of course mentioned about a couple of case studies, but just wanted to take your thoughts on the same.
I think the process, put aside all the tax deductions, should be very similar, I think, to a typical de-SPAC transaction. But when it comes to tax deduction, I think it could take some time. I think it really depends on the profile of the target. Particularly when you have different options of deducting and the different options in different results to the stakeholders. Often there will be a negotiation between the SPAC in terms of which structuring you, and also you need to consider, there will be legal issues, right? One tax structure versus another. So lawyer legal advisor will also need to involve. So I will say varies, but 1 to 2 years is a timeline.
Sure. Thanks, Hong. Now, there's a question for you, and let me take that question first. Can you please elaborate more about stamp duty in China? Especially, there will be a new SD law soon.
My understanding of the new stamp duty law is probably similar to the existing law. I haven't really take a very close look at the new stamp duty law, but my understanding is based on the draft, right? The draft looks quite similar to the existing one. So the question is really whether that merger document or share transfer document or other legal document, because as I mentioned, there actually will be multiple steps lead to the SPAC transactions. So other than like a merger agreement, there could be incorporation or other agreements. You have to see whether these agreements will be, used and enforced in China. So that's the threshold for transaction stamp duty in China.
Sure. Thanks, Hong. So Jack, before I take the next question, I want to ask one question to you, and this probably a question which is in mind of many of the listeners. Mm-hmm. Jack, I think there is an understanding, or there is some kind of a perception in the minds of Indian companies that if we do a SPAC, then they probably can overcome some of the mandatory requirements of, say, IFRS conversion or audit reporting or SEC reporting. And you did mention, and we did speak about it, that I don't think so there are any shortcuts. On the timing side, we discussed that maybe in SPAC, you can see the money first in the account, and then you can undertake such kind of exercises. In your experience, Jack, if a SPAC money is already sitting in a escrow account, and if someone wants to do a de-SPACing transaction, what is the estimate of timelines which you probably would have experienced to complete all the reporting requirements from an audit and accounting perspective?
Yeah, so I think, fair question. The easy yardstick that I always tell my client or any prospect company that's looking for this process is to just think about it from the fact that how long has it taken them from an audit perspective previously. And quite honestly, yes, we are talking about a PCAOB audit, which is, some may say, yeah, is how is it different from the audit that we are going through? Yes, it is quite different, but how much more does it take, right? Especially if I was to use the same audit firm that has been auditing us. I would say there's still quite a fair bit of work that needs to be done. And I guess looking back historically, if your company takes about 3 months to do the audit for a year, if you were listening just now, that you are looking back, and depending on how many years you need to prepare for the purpose of the filing, if it's a 3 years that you need to have inside the filing document, then essentially you're almost talking about a very compressed 3 years, quote unquote, re-audit. Not necessarily the full thing, but quite a fair bit of step up that needs to be done. So even if you were to shorten it, I would say most of the time a reasonable or expected timeline will be 4 to 6 months to complete that, and depending on how fast and how big the group is, spreading different country jurisdiction, then obviously then the amount of time will vary as well. Hence, I think quite important point here is that there is any compensation around this SPAC. Don't think of it as a shortcut. Don't think of it as it'd be much faster, because I guess for us in finance, we definitely don't want to be the one that's holding everybody else, and want to be able to complete everything in time for the transaction as well.
Thank you, Jack. So there's another question which has come up, which says, from India perspective, if one of the investor in SPAC is Indian, whether an individual or a company, can SPAC acquire Indian operating company? It's a very good question. I did touch upon this. So in India, we have this regulatory issue under ODI and the FAQ, especially FAQ 62 and 64 on the ODI. And in our view, we should seek an approval of Reserve Bank of India, because currently it is considered as a kind of round tripping, even though money may not come back to India. But it's better to seek an approval of RBI. In our experience, whether approvals are available, yes, it is case-to-case basis, but it's not that RBI is averse of giving an approval. Approval may be sought, and RBI has given approvals in the past. So it's not that they are averse of giving the approval. But having said that, I just want to put one point, and I'm sure most of the Indians who are on the call, they would have read this in some other news headlines, that RBI is actually considering to relook at the overseas direct investment guidelines. And chances are that SPAC or maybe the global funds or et cetera, which is going to be the future, they may allow Indians to hold shares or units in an overseas vehicle, which probably in turn invests in India. I'm sure there will be certain guidelines which will come across it. This is mainly coming up because of the startups, the demand which has come from startups and technology firms. But I'm sure if they are phasing a guideline, they will probably do it with all the aspects keeping in mind together. So till the time that guideline doesn't come up, and till the time we probably don't do a detailed discussion on the guidelines, as it stands today, approval from RBI is required. So friends, I can see that we are very close to the end time. So if there are no more questions, then maybe let me proceed to thank both my colleagues. So Jack and Hong, thank you so much, and special thanks to all of you who are able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit the debrief website. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think any other questions or comments later, please feel free to reach out either to me or any of our speakers. We did be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Global Mobility, Talent and Reward series on 3rd June titled Remote Work, Setting the Right Strategy. At last, from all of us at Deloitte, thank you for your participation in Deloitte Asia Pacific Tech Webcast today. Goodbye.
Thank you.